Hello, I'm Andrew Knight from RICS, and I lead the RICS Tech Partner Program here. I'm very happy today to welcome you to this episode with one of our RICS Tech partners, Proplend. I've been with RICS for over 10 years now. I have a background in general commercial and data and technology. I sit within the overall part of the business that looks at data and technology and its effect on real estate and the built environment right across the full life cycle. Additionally, in the past, I managed our engagement with the City of London, focusing on the capital market. So I'm particularly interested this morning to talk to Brian Barterby from Proplend. So welcome, Brian. And I guess my first question, always talking to our tech partners, is can you give us a bit of a backstory on why Proplend started, you and your team's skills and experience, and paint a picture for us, but behind the name Proplend?
Absolutely. Well, Andrew, thank you very much for hosting this morning. So Proplend is one of the leading technology platforms for investor-funded commercial property loans. We match commercial property investor demand for term, bridge, and VAT loans with lender demand for regular monthly income supported by high levels of capital protection. So commercial property investors who are our borrowers currently struggle to source liquid and readily accessible capital, as traditional banks find it increasingly expensive due to Basel II and Basel III to provide commercial property investment loans in the long-term low interest rate, or the very, very long-term low interest rate environment, which we now find ourselves in. Investors who are our lenders are looking for attractive rates of risk-adjusted return. And that's something that commercial real estate debt can provide. And the Proplend platform is really a distribution platform, and all we've done is we've repurposed a very long, well-established institutional asset class, which is commercial real estate loan syndication, by offering investors loans which are split up into 3 different loan-to-value based tranches, which enables investors who have different risk parameters and return requirements to all participate in the same loan. And we have retail investors, we have ISA investors, we have pension investors, corporate investors, and some small institutional investors. And Proplend came around because I've been in property finance since 2003, sort of structuring residential, commercial investment development transactions the whole way through the capital structure. And in 2007, 2008, when the financial crisis happened, I was very much sitting at the coalface and sort of watching what happened. And what we saw 2 things happen. One was banks pulled out. There was a massive liquidity of non-liquidity for lending. And secondly, interest rates went down pretty much to zero overnight. So you had two different people with 2 sets of problems. One was people who had loans or were trying to buy property and couldn't get lending, and there was a lot of cash in the system that was looking for, bank interest rate went from 5 to a quarter overnight. So that's a big drop. So looking for funding, and what happened was vast quantums of money moved across to commercial real estate debt funds. So AXA, Aviva, M&G, LNG, massive big funds, 2-3 billion plus funds, struggling to write a ticket less than £100 million. There was quite a lot of mezz funds who can out and raise money. They suddenly found out there was no one to sit behind, so they became stretched senior lenders, and sort of was still able to offer the same similar type of returns that they told their investors they were going to go offer. There was a couple of bridging companies left around who were still sort of doing some of the sort of residential development type things, but the sub £5 million commercial investment had 95% being funded by the branch manager of your local high street. Yeah. So if you were trying to buy a property, you'd have walked up the road to your local high street, you'd have gone into Barclays, whoever, the branch manager would have written out a £3 million check, and that just disappeared overnight. And that was where we suddenly realized that no one was stepping in to look at that space. And I just looked at what I thought was quite a simple, I like simple things, and it just seemed to make sense that, if we can just repurpose what was already out there, which was commercial real estate loan syndication. So you have 3 lenders, £1 billion loan, 3 different lenders, one takes a junior, one takes a senior, one takes a junior, one takes a mezz piece, 3 different lenders, different types of risk and return. So rather than doing £1 billion loan, let's make it £1 million loan, and rather than one lender taking the whole slice, let's slip it into, or slice it up into £1,000 loan contracts, so that you personally now have access to an asset class which you never had access to previously, because you'd have had to have £5-10 million to go and give to somebody the likes of AXA or Aviva, or if you had £1 million, you'd have been able to write one loan at any one point in time, which is all your eggs are very much in one basket. There's no diversification. Whereas here we allow our lenders, or we enable our lenders to build their own loan portfolios, diversified across different asset classes and different geographic locations.
Exactly, and as you mentioned, those Basel 3/4 kind of risk-weighted asset type calculations have obviously made, particularly development finance, quite a difficult area for the banks, haven't they, in terms of the amount of tier one they need to put aside for that. So I guess that drove a lot of their, plus the pricing issues, I suppose that drove a lot of their movement away from this sector, did it, Brian?
Yeah, so I'm just unplugging the phone that's sitting beside me so it doesn't ring. Yeah, and definitely on the development side, so actually, sort of development, there's still interest. So where the banks have gone, they've gone into SME lending, and they've gone into resi development lending, because that's still quite a good story. If you're lending to an SME, you're creating jobs, you're adding to GDP. That's and there's a trading entity you're lending to. And the same with a residential development, there is a sort of trading entity that takes place for a certain amount of time. Whereas with a single asset SPV investment property, there's pretty much someone goes and buys a property, puts it inside a limited company. There's a tenant in place. The tenant pays rent in one side, and a bit of interest goes out to the bank the other side. There's no employees. There's no trading. There's nothing really happening there. So that's not really that interesting for a bank, because there's not much they can cross-sell into that. And as you said, that hits their balance sheet fairly heavily on the way they've got to lay capital down to cover that.
So is that because obviously you need capital at various stages of that property life cycle, through the land acquisition, the development, and perhaps bridging, and then into that kind of more investment phase. Is it more that investment phase that you're finding the borrower demand is coming from?
Yeah, so there's demand everywhere, but we focus primarily just on commercial and primarily just on an investment transactions, where someone's bought property for an investment. They might be doing so we don't allow any development on our properties when we have loans on them. So it could be someone either just buying it as a pretty vanilla, buying a property, it's got 10, it's yielding X%, very vanilla transaction, and I'm just holding it and that's it. I might do some lease work when a lease comes to the end of term, or there's a break or something like that. Or it could be someone just repositioning a property, so taking they might already have planning and they're trying to do an uplift in planning. We've had it where we've actually had a client who they had a fully tenanted property, but they also in the background got residential planning permission. And what they needed that property to be empty in order to sell it to a developer, so the developer could actually start to work on it. So that was a leasing down transaction. So again, the other thing that I should say, I wasn't a techie. I still am into techie. I know enough to get myself into trouble and cause problems with our tech guys. So we weren't a bunch of techies who built a platform and went, hey, we're going to do property lending, because unfortunately, I think a few other platforms have tried that, and it's failed miserably, because fundamentally we're still in the lending business, and we're in the lending money out and getting money back business. We've used technology to make that a more efficient process. We haven't automated underwriting, and a couple of people have tried that as well, and that's been quite a disaster. We're still on. If you came to us as a borrower, you would get a different experience, a better experience, we hope, than you would get if you went elsewhere. But fundamentally, we're still going through a lot of the same processes. We're just doing it in a much more efficient way, than using technology to do that more efficiently than than the banks historically have done. And then obviously the tech side kicks in on the lender side of the platform, because that's where we split the loan up into the tranches, we split the loan to £1,000 loan pieces, and it's a distribution platform that allows the lenders to come on, and we have various other bits on the platform that allows people to either manually invest or auto invest. As I said, we've got secondary markets. The bigger amount of tech has happened on the lender side, but there's a very strong and growing PropTech environment in London and the UK, and that's probably 3 or 4 years behind Fintech. So there's some really interesting things that are starting to push through, that we can now look at and go, oh, actually, look, these guys are now providing a lot of data. We could never get that data before. Or here's a way of putting data together quicker. We can now use that. Or monitoring a loan as it goes through its life cycle. So there's definitely things that we look back and go, okay, what else can we bring to, add on to what we do that makes our processes better and more efficient.
So obviously, to a large extent, what your platform is doing is supporting that distribution piece in terms of actually getting the debt then out. And as you say, you've got that secondary market, which I know is also a really powerful piece to have that depth and liquidity. I guess for some of our listeners who perhaps don't get some of the jargon, you talk about splitting it into tranches as well as that syndication piece. Could you perhaps explain the kind of the fundamentals of the capital stack in terms of senior, junior, mezz, and therefore how you can actually match the kind of risk appetite of the lenders to those different tranches of say, to use the jargon, the capital stack, as it were?
Okay, so we would do any loan that maybe is up to 75% loan to value. So that's the maximum loan that we look at. And with any loan, we price risk on a loan by loan basis with the borrower. So it depends on what the transaction is. It depends on what is there income coming off the property, is there not income coming off the property. So it's up to 75% loan to value. So let's say we agree a rate for the borrower at 6.5%. That's what the borrower's pay rate is going to be on this loan. What we then do is we say, right, we'll split the loan into a 0 to 50% loan to value tranche, a 51 to 65, and a 66 to 75. Now, we might not always have a 75% loan to value loan, so we've only got, if it's only 50%, there's only tranche A. So it's tranche A, B, and C. And in theory, that is equivalent to senior, junior, mezzanine. And what we do is we take the 6.5 rate and we then split that across the 3 tranches. So it's an easy one to split. The 6.5 goes very nicely into 5.5% in A, 7.5% in B, 10% in C. And what it means is lenders get the opportunity to go, actually, I'm a low risk investor. I'm investing to use my pension. I don't really want to lose any money. I'm happy getting 5.5%. And I know I've got a 50% loan to value cushion sitting behind me. And there are other lenders who will go, actually, I'm a bit more racy. I want 10%. They'll sit higher up the capital structure. They'll get 10%. And then we have a waterfall that sits across those tranches, which says tranche A gets paid back first, tranche B gets paid back second, so tranche C gets paid back third. So everyone sort of understands where they sit, and obviously the higher up the capital structure you sit, the more risk you're taking, the more return you expect to receive. And then separately, we have so borrowers and lenders. Actually, so again, this is where technology is very useful. There are so in a £1 million loan, there is £1,000 loan contract. So every single loan contract has got the borrower's name on it and has got the lender's name on it. Separately, we have our own security trustee company, and the security trustee company enters. It instructs valuations. So we do red book valuations for every property. It instructs legals, and we do reports on title or certificates of title on every property, and we hold those on trust on behalf of the lenders. And then we also the security trustee company enters into the security documentation. So we take a first legal mortgage charge, we take a venture, and we take a personal guarantee. So it's the same sort of documentation is used. We have the same valuations that take place. We have the same reports on title take place. So whilst everyone thinks, oh, this is something new, we're not changing the fundamental structure of a transaction. It's still happening the way you'd expect it if you rocked up at a bank, high street bank tomorrow, and they lent you that money. You go through the same process.
As you say, so it's that good, dare I say, old-fashioned due diligence that's merely having tech supporting it and making it more efficient, and as you say, acting as that distribution piece. So, I mean, how does it fit within the regulatory environment? Because obviously people will always be concerned, if that's the right phrase, to make sure that they're working on a platform that is still within kind of the real world, if I can say, given that tech sometimes has a reputation for being outside and disconnected. How does it work within the regulatory environment, Brian?
Okay, so the underlying, commercial lending is fundamentally unregulated as a product by the FCA. So if you were a bank doing it, you'd be doing it as an unregulated basis. You wouldn't have to be regulated to do it. The platform, Proplend, the platform, who operates the platform, the actual the platform itself, is authorized and regulated by the FCA, and that authorization is called permission to operate an electronic platform in relation to lending. So it's quite a horrible term, but that is actually what the FCA regulation is. and that allows us to manage the platform, create all the different loan contracts, do everything we need to do. Plus, we also we run our own client money accounts, so clients put money into our client money accounts, which we then sort of manage. So we have to operate under CAS 7 rules. So every month we have to report back to the FCA through reporting structures, what used to be called Gabriel, and then quarterly we report to the FCA on the wider platform. Because we run a client money account, CAS 7 client money account, every year we're audited by our auditors, who then have to report that back to the FCA. So we are authorized by the FCA. The lending and the process of peer-to-peer lending, which is peer-to-peer lending, I sort of hate the terminology, and a lot of people in this industry do, but it is what it is. Is not covered by financial services compensation scheme. So if somebody loses money, it's not covered. While money is in our client money account, that's covered by financial services. Obviously, it's in our client money account. When the money goes out on loan, then it steps out of that protection, and you now have the security of the asset that the loan is secured against.
Exactly, the underlying asset.
The underlying asset, and then obviously when income, so interest gets paid every month. So as the income gets paid back in, it gets paid back into our client money account. It again falls under the protection of the financial services compensation scheme. And if you as a lender took financial advice, then you're covered by the financial services compensation scheme. You're not covered for any losses in the same way as you're not covered for losses in any financial services compensation scheme, but you're covered the fact that someone could have given you bad advice or that entity doesn't exist anymore. So there
exactly.
And that's no different than any other financial services product.
But as ever, I suppose it highlights the importance of once again, I'll use the phrase old-fashioned, but the old-fashioned red book valuation, title report, that due diligence around the underlying asset, because ultimately that is the security for any lender in commercial real estate, isn't it?
Yeah, and we're totally transparent. We have what we call a citing paper. So when a loan inquiry comes to us, we might put some terms out in it. We do a citing paper, which is internal, that will just say here's the transaction. What do we think of it? So we've got an internal credit committee. We like it. We don't like it. We always try and give borrowers a quick no. But then we'll say, okay, we like this transaction. Here's what we need to look out for. Things we need to highlight on this. Make sure we've got these covered. Then we go into the deeper due diligence. Legals are instructed, valuations are instructed. We have a final credit paper before it goes live on the platform. And when the loan goes live on the platform, the lenders get to see some headline information about the transaction. Then they get to read the valuation report, so they can read the full valuation report. They get to see our credit paper, which we call a full loan request. It doesn't have our comments on it because we're not. So the one thing we're not authorized to do is give advice. So we can't say, hey, this is a great loan, you should invest in this. But what we can say is, here are the facts as we've seen them. This is the property, this is the borrower, these are the tenants, this is the location, this is the rental income. So we go into quite a lot of detail. So as a lender, you know exactly who you're lending to, you know exactly what the property is, you know exactly the rental income of the property. You be able to read the full valuation report. So you have a lot of information to make an informed decision on whether you want to invest in that loan or not.
Yeah, indeed. No, I suppose it's a great example of where technology is aiding and complementing not a manual due diligence, but a proper due diligence process. So it's not some kind of black box that is making decisions. There is the relevant human in the loop, to use the phrase, to make sure that actually there's that good solid due diligence, and that the technology is not a means to an end, but a way of actually simply making the process almost more transparent, arguably, and easier for people to make decisions and then move the money around in a sensible way. And I presume you have your own platform for the secondary market as well within this overall tech platform. So
yeah, so so we built it, which allows a lender. We can't guarantee any liquidity on it, but what it does is it allows a lender to say, look, I've got £10,000 loan parts. I need to go and buy a new car or something. I need the money. So as long as the loan's in good order and good standing, then they can place the loan parts on the platform themselves. Everything sells at face value, plus the there'll be an accrued interest, so however much interest is accrued from the day,
Yeah.
from the date the last interest payment was made
Yeah.
to today, and that's then available for other lenders to look at. And another lender might look at it and go, actually, do you know something, I missed out on getting into that loan. I quite like that. I'll go and buy it, and they go and buy that. And we're very lucky. We've during obviously last year, we had quite a lot of lenders who they didn't quite know why they wanted liquidity, but they did. So they were selling loan parts. And we had another lot of lenders who actually said, you know something, we like this product, we're very happy with this product, and they bought it all up. So we've had lenders who've been able to sell up to £100,000 of portfolio within 24 hours. So it's quite there is liquidity there, but it's only, we don't control that liquidity. It's
exactly, yeah. I mean, as you say, that's down to you need, for every buyer you need a seller, don't you? It's simple market mathematics. You mentioned the sort of the fact that arguably kind of fintech is ahead of PropTech, and I guess this is interesting in the sense it's showing that when you combine these various jargon terms, you've got, as you say, client protection, you've got this financial technology, but PropTech is hopefully catching up with the ability to get more data around assets. And you mentioned that that's helping you, that ability to get data about assets is presumably helping in terms of that due diligence process.
Yeah, definitely. I mean, so obviously the majority of information lives at the land registry, and that's historically been quite an old traditional process. They're running very hard to get that into sort of a digital format, which then becomes much easier for people to use. Commercial property, there's very good data, the likes of CoStar at the sort of 5 million plus level. Residential, there's always been people, PropTech always goes down residential first because there's more users and more requirement for it. But sub £5 million commercial real estate, there was just appalling data, like really bad. And we're slowly starting to be able to find pockets of good data that we can start to use. And also just there's lots of the property industry had quite a traditional industry for a very long time. There's lots of middlemen in it. There is lots of there's traditionally thousands of bits of paper fly around the place, and it's quite a old-fashioned industry. And I think slowly that's now becoming a better. People are sort of getting the concept of digitizing stuff, and actually what it allows you to do is people are building sort of slightly more niche products, which if you start sort of joining a couple of these niche products together, actually it brings you some quite useful stuff. So there's definitely stuff that's coming on there, and as you say, we're sort of sitting at the sort of the middle of sort of fintech, PropTech, and then RegTech. And RegTech is really just about being able to onboard someone much quicker, both a borrower and a lender, from the point of view of traditionally I'd have said, okay, I need to see your passport, and you need to give in, I need to see it, I need to certify, that type of thing, I need a bill less than 3 months old type thing. Now we can onboard people much quicker, so we can onboard lenders directly through our website, as long as we can get sufficient data on them through the digital methods we use, then they can be onboarded straight away. When sometimes we have to revert to something that says, okay, actually we can't find you, so send me your passport, send me this, send me that. But it just makes the use of so part of the financial technology works is the internet, which makes things you can transact and view things, and I think investors have become a little bit more. I'm actually a bit more comfortable about making my own financial decisions, and potentially I don't want to rely on my wealth manager or IFA, or if I'm going to lose money, I'd rather lose money and go, well, actually it's my fault, I made a mistake there, I'm my wealth manager, and I'll live with that. And also the ability to move money and payments, and the fact that you can actually log on to the app on your banking app on your phone and send me £100,000 and it's in my client money account 10 minutes later. So the combination of those things has enabled sort of fintech to take place, and that sort of comfort level that people are now happy to log on to a website that they've never, we have clients we've never spoken to, who come on and just sort of get on with it. And when you speak to them, some of them go, do you know what, I really like the fact that I'm not being sold to. I do what I want to do, and I can, it's my choice when I do or don't do something. And other people like a bit more hand holding, so you just got to find that sort of that happy medium. But definitely there's data, processes, even things like electronic signing of documents. Again, that's become a massive thing. Obviously, COVID has helped. The lockdowns have helped sort of promote that, and a lot of property companies, their sort of digitization wasn't driven by their CTO or their sort of process and policies they had. It was driven out of necessity when COVID came along, when they suddenly went, oh, how do we do this? So
exactly, yeah.
There's been a huge amount of digitization taking place, which I think is fantastic.
You're right, and I suppose it's thing, as you say, you talk about pockets and niches, but it's about that ability to get abstraction of lease information, get better information on covenant strength, which obviously, as you know, are the key kind of drivers of risk and reward in commercial property. You want to know who's in the building, what rents are being paid, and when are the breaks, and what are the lease lengths, and all those things that help you understand those future cash flows, which is such an important part. And I guess it's also interesting, once again, that back to basics, if we still need the know your customer checks, but if those can be done digitally, once again, technology can support that. And I suppose similarly with things like client funds, I know with platforms like Modular, where you can create those virtual bank accounts, it's much easier actually to manage client funds rather than the old-fashioned way. I think there's always a danger that people think that digital is less secure, when actually it can be more secure, that actually you can have better processes rather than manual photocopies of passports and driving licenses and things that arguably are more error prone in that way. So I think it's a good example of how digital can be a better experience. And I think it's interesting your point that sense of agency that people can have, that, well, actually I can control this now. I don't have to rely on an advisor. I'm a experienced investor. I want to make those decisions, and digital can give you that agency of being able to do that without having to use third parties. If you as you said yourself, you want to make your own decisions, and you're doing it in that intelligent, informed way. Well, I guess one last question.
Things like the, just sort of, sorry to cut in there, but things like even we've got down to, there are property platforms now where you can exchange and online, and that exchange is ending up being put on blockchain, which is again that's quite a that sort of really messes with a lot of property investors' heads about how does that happen? How can I possibly do that? It's got to go through my lawyer. It's got to do this or that. That's a sort of a big thing. And one of the biggest sort of property things was commercial property auctions. So obviously they all got shut down during lockdown. And the physical being in the room. And they were amazing. They moved incredibly quickly to online auctioning. And in actual fact, it's I think it's been a huge success for them. While there are certain people who still want to go in the room and meet their friends, and there's a social atmosphere to it, the actual just getting business done, it's an incredibly efficient way of transacting. Some people like it, some people don't, but that's a huge shift in the way that property is being transacted. And we're not going back. We're not going to leave. We're not going to go, look, we're out of lockdown now, we're throwing that away. That's very much here to stay. That's embedded now within the way that we look at transactions.
No, indeed, and you've almost answered my sort of final question, was that future, because as you say, and although things like blockchain have a role to play, this overall kind of fractionalisation of real estate in this way doesn't necessarily need blockchain in terms of what you're doing. You're effectively giving that democratization, I can never say, that fractionalization that says, actually, as you well know, commercial real estate is a large lumpy asset type, and people want to invest in it if they're, if they do have that depth of knowledge and agency, but they don't necessarily want to spend 5 million, but they do want to spend 200,000. And it's that ability to get that fractional exposure and reward to commercial real estate, which has always been lacking, to be honest, because it's such a large lumpy asset, even at the lower end, isn't it? So
it is, and it works both at the debt level and also at the equity level. People are fractionalizing the equity slice, and people are I love sort of the fact that we've got such a wide client base, because, and you talk about why did you invest in that? I remember the first transaction we ever did, someone said, oh look, I know exactly where this property is. I drive past it every day on my way to work. So they felt comfort. They could drive past that property every day, and they could sort of see their money. So that gave them great comfort. It was a localization thing. And then we have other people who maybe say, look, I go to Costa every day and I buy coffee in Costa every day. And we put a Costa on maybe up in Newcastle, and they live in London. And they go, well, actually, I don't really care about the asset. I'm buying the brand. I know that Costa are someone that I pay money to every day, so I sort of feel as if I'm participating in that. By there's people up in Newcastle who buy a coffee every day there as well, so I should be okay. And the sort of the assets almost a secondary, is incidental to the transaction, even though it's fundamentally supporting the transaction.
Yeah.
You can never quite tell why people like a transaction, don't like a transaction, and you think you're just getting to know your client base about the sort of things they like, and you put something up and they look at it and go, really? You know, so
well, I suppose it's back to that classic thing that commercial real estate is so heterogeneous that, as you say, sometimes you're just going to do it on covenant strength, and otherwise you might do it, well, I live in that town, I know that asset's going to perform well, I know the local economy, I'm comfortable with the fact that it might not have a headline, blue chip occupier, but I know that that's a very vibrant community, and that asset will produce income. So as you say, it's that sort of heterogeneous nature, and you don't want to prejudge the market, do you, in terms of what decisions people make about why they invest in a particular asset. So
yeah, I mean, the other thing I love about commercial is the fact that it's just so varied, and because everything that isn't residential is commercial. So and everyone still goes, oh yeah, it's office, retail, and industrial, but in actual fact, it's not. This, the subsectors that have grown out of those three original sort of headline asset sectors. And we've done everything from the classics, retail, offices, industrial. We've done pubs, hotels, restaurants. We've done student accommodation. We've done a marina. We've done a religious centre. We've done a vineyard. So we're fundamentally driven by property, and as long as we get a head around why are you buying this, what are you doing with it, how are you going to pay us back, and we get the property story, then that's what we're really interested in. That's what you get to grips with. And again, you could have two assets side by side on the same street. One's let to, I don't know, Tesco's for 25 years, and you've got a fairly decent covenant there. You think you're going to be okay, and you've got the next one is me. I've just set up a new business. I'm a startup. I might be paying the same rent as Tesco, but guess what? Those two buildings, even though they're physically identical, are trading off a very different yield, and they're obviously at a very different price. So exactly. You're always looking at something new every day, and I love when we look at that, and it's important because we have to give our investors sort of diversification. We can't let them go into the sweet shop and just have the same sweets every day. We've got to make sure they get the opportunity to geographically and asset-wise look at different stuff.
Well, yes, and obviously, as sort of intelligent investors, diversification is high up there on what they should be doing, as you say, and making sure they don't put all their proverbial eggs in one basket. So one final question. It's been fascinating. If you get your crystal ball out, I mean, we've talked about the rise of online auctions, obviously this fractionalisation. What if you could predict the future, what do you think the direction of commercial real estate funding will be, given all these various trends and currents, and obviously the PropTech, Fintech type support as well? Where do you see it heading?
I think the banks are going to struggle to come back to this space in the bit that we operate in. I think they've shut down their the net banking network, branch network is sort of gone now. So I don't think they're ever going to make a huge impact back into our sector. And I think that will become much more driven by alternatives. So it could be either a balance sheet lender. There's just so much money sitting there desperately trying to find a loan at the moment. So credit funds will allocate to certain areas of that. So I think there's a big there's a huge amount of growth within our sector out there. Obviously, when you talk about the different sizes of commercial property, again, there's lots of money flowing into the big debt funds, the sort of Vivas, all these sort of guys. They'll still fund the multi-billion-pound transactions. It would be nice. There's some good headroom, I think, sub 10 million for us. So we could maybe push a little bit higher on loan sizes without much competition. I think once you start to get the 10 to 20, there's some smaller debt funds who are starting in that sort of 10, 20, 50 type region. So I think depending on which price point you're at, I think and the banks, if anything, will come back and play in the bigger end of the market. So they'll write £100 million ticket out rather than writing out £101 million ticket. So I think there's commercial property. If you read, what's in the media, everything's all over. Commercial property is horrible and it's going to lose money. Commercial property is held up unbelievably well.
It has, yeah.
Allsops just did an auction the other day, which is very much the type of kit we look at. They were 88% sold on the day, lots of retail getting sold, at decent prices as well. It's not knockdown prices. We're not in the middle of a sort of a fire sale. So I think there's investors are definitely still looking at commercial property. Planning's changed on some of it, so they may be looking at planning angles. 25 years ago, everyone wanted high street retail, and no one wanted industrial sheds, and now we've totally flipped. Everyone wants industrial sheds, no one wants high street retail. So it's always cyclical in that manner. But yeah, I'm still pretty keen on looking out at what I think is coming. And again, it's the other thing which banks I don't think ever really got was, so people who put money into the bank as a saver were almost their clients. They didn't really look at the borrowers as a client, and you're lending money to them, so they're not really a client. They're someone who's using you, but in actual fact, borrowers are clients. And if you treat your client well and give them a better experience, then they actually go, wow, that's I haven't really had this before, and you sort of get our business and you understand what we're trying to do, and you can see past the box ticking that some lenders have obviously had historically, and it's you've got two sets of clients. You've got to treat them differently because they're different clients, they have different requirements, but they're still clients and they still need looking after, and they still want to have a good customer experience, because if they go and borrow money personally from a bank, they'll probably have or not even a bank anymore, but some of these online things, they'll have a sort of a UX experience or a UI experience which they never would have got going to a bank.
No, as you say, I suppose it's a good example to close that digital doesn't mean that it shouldn't be a good experience.
It has to be a good experience. You can digitize something and it's still horrible.
Yeah, exactly.
Just because you digitize it doesn't mean it's brilliant.
Exactly.
There's a lot of stuff, I still look at some of the stuff that we've got now going, oh my God, we've got to change this. And it's just a matter of, there's so many things we want to, because you always want what you've got to be amazing and perfect. And the other thing is we're never finished. So we've got a platform and we've got, how our borrowers and lenders interact with us, but that's a never finished process. Because I think a lot of people, buy some software or build some software and go, right, that's it. And it's sort of, that's the next 10 years of my life. We're done now. That's all. We're not doing anything else. Whereas it has to evolve, and it, sometimes on a daily basis, we'll look at something and go, "Oh God, if we did that, that would make that such a better thing." Yeah. And you only learn by doing it. So it's do it, learn, try and make it better.
Learn again. Yeah.
Try and make it better. And again, being a smaller, sort of more agile company, you can look at it and go, "Yeah, let's change that." And it has an immediate impact on both your sets of clients. Whereas a bank just, it's the old adage, they're tankers. They can't turn quickly. They can't change things quickly. Whereas, someone can come up with an idea in the morning and it could be out in the afternoon.
Yeah, exactly.
If we think it's a good enough idea, and we're not scared to try something and go, actually, it didn't really work. So, we'll change it back. And you just got to, you've got to try these things.
So it feels like that the direction of travel, it will just continue, won't it, in terms of these trends from what we've discussed, I think, which I think is great. It does indicate that there's a great mix here of good old-fashioned due diligence and the relevant use of tech to deliver that. So it's been great to talk this morning, Brian. Great conversation. I look forward to talking again soon.
Well, thank you very much, Steve, for having me on.